In this topic, there are three main groups of questions. First one will be focused on international trade. Second one is balance of payments, and the final one is exchange rates. So let's have a look at international trade. Gains from trade, source of gains from trade, mutually beneficial trade, gains from trade. As you can see here, all of these exercises are asking you about the source of gains from trade. And in order to figure out this, you'll need to know the meaning of two concepts: absolute advantage and comparative advantage in international trade. There might be some questions based on this in the question bank as well. So let's have a look what is absolute advantage first. Any ideas? Absolute advantage. What does it mean to have an absolute advantage in international trade? When you are more efficient than other countries, in what? In doing what? Yes, in making certain goods and services, in producing certain goods and services. Specifically, if you are able to produce with the lowest cost, lowest absolute cost, right? When you are able to make a certain item, to produce a certain item with the lowest possible costs. And obviously, if your country has this advantage, you will be able to benefit from this. For example, Colombia has an advantage in producing coffee. Other countries can make coffee too. They can grow coffee beans. However, it's just more expensive for them, and Colombia has an absolute advantage in this. Or Saudi Arabia had an absolute advantage in drilling oil. Again, there are a number of oil-producing countries, but the cost of producing oil for Saudi Arabia is the cheapest. And apparently they benefit from selling their oil to other countries because it's just cheaper for them. They can maximize their profit. Absolute advantage. The second concept is comparative advantage in international trade. Any ideas of what this might mean? Lowest opportunity cost, absolutely correct. It's a situation when a country has lowest opportunity cost in producing a certain item, goods or services. What does it mean to have the lowest opportunity cost? It implies that when you're focusing on the production of a certain item, you need to sacrifice less of other items. You need to give up less of other production, of other types of goods and services. The best way to explain it is to look through an example. Let's imagine that we have two countries, let's say US and Japan. And these two countries can produce two goods, wheat and rice. Let's imagine that they have different production facilities, and US, America, can produce 30 units of wheat or 10 units of rice. While Japan can produce 15 units of wheat or 30 units of rice. Or they can produce certain combinations. They can produce one or another, or maybe half of each, but they cannot make all of these items together. They need to choose. It's a concept related to production possibility frontier. They need to choose certain combination, and this is the maximum which they can produce. The question is, there is no country which would have an absolute cost advantage in this situation. Would trade still be beneficial? In fact, yes, because opportunity costs of producing wheat and rice are different in two countries. Let's calculate the opportunity costs of producing wheat for both countries. What does it mean? How many units of rice do we need to give up in order to produce 1 unit of wheat? 3 units of wheat is equivalent to 1 unit of rice. If you want to make 1 extra unit of wheat, you need to give up 1/3 units of rice. This is an opportunity cost of producing wheat in the UK. 3 wheat is equivalent to 1 rice, right? So 1 wheat is 1/3 of rice. For Japan, the relationship is 15 to 30, or 1 to 2. So 1 unit of wheat is equivalent to 2 units of rice. If you want to produce 1 extra unit of wheat, you are giving up 2 units of rice. Do you see this? To make it a bit clearer, we can produce 30 units of wheat or 10 units of rice. This is equivalent that you have 3 wheat or 1 rice. Therefore, 1 wheat is equivalent to 1/3 of rice, something like that. And similarly here, 15 wheat or 30 rice is the same as 1 unit of wheat versus 2 rice. So we have 1 to 2 relationship, right? These are our opportunity costs. Let's have a look what are the opportunity costs of rice in both countries. In other words, how many units of wheat each country will need to give up to produce 1 extra unit of rice. Here the relationship is 10 to 30. To make 1 unit of rice, we need to give up 3 units of wheat in America. And here we only need to give up a half of units of wheat to make 1 extra unit of rice. Japan can produce more rice. It's easier for them to give up some of the wheat. They can make more rice. So it's cheaper for them. They need to give up less wheat to produce 1 extra rice. And that's way around in America. So these are our opportunity costs in both countries. So these are kind of prices of wheat and rice expressed in another good, expressed in an alternative product which they can also produce. These are kind of prices. So, and this opportunity cost, these opportunity prices become our decision-making criterion for international trade. The country should produce an item which is cheaper for them, which has the lowest opportunity costs. So in this particular situation, America should produce wheat, should specialize in wheat, and Japan apparently should produce rice because it's cheaper for them. These are similar, these numbers, a third and a half, are kind of prices. These are kind of costs of production expressed in other items, in other goods. Because the opportunity costs here are lower, a third rather than 2, US should produce wheat, this item, for which opportunity costs are lower. And here for rice as well, it's cheaper to produce all rice in Japan. Right? So these are kind of prices. So very similar concept, but expressed in a slightly kinked way. What is interesting, what is important about comparative advantage is that countries in this case can have mutually beneficial trade. When a country has an absolute advantage, it is this country which will benefit if it will sell its products. For example, Saudi Arabia, which sells oil, obviously will become richer compared to countries which are forced to buy this oil, simply because it just absorbs all of the profit. When countries focus on comparative advantage, like in this scenario with US and Japan, they can both benefit. Trade will be beneficial to both parties because both parties will be able to enjoy more attractive opportunity costs for a combination of goods. So to give you an example, so let's think about opportunity cost as a price, right? It's a price. When countries trade, they might be able to set a price in between these numbers. For example, set a price of one unit. Again, it's a price expressed not in pounds, not in Japanese yens, not in dollars, but in terms of other items. So let's make the price in between. Instead of a third or 2, the price will be 1, which means that America will be able to keep 2/3 of this unit as a profit. Its cost is 1/3, price is 1. It can make mutually beneficial deals. Right? It will be able to produce with this cost, sell at this price, and keep the profit. And it is also more beneficial for Japan because instead of paying 2 units, it will only need to pay 1. The price for them will be cheaper. It will be cheaper to buy rather than to produce themselves. The same for rice. We can set a price, a global price. We can agree with our trading partners to set a price of, let's say, 2. Again, 2 units. It's very beneficial for Japan because costs for them are a half, while the price is 2. They are making profit. And it's beneficial for US as well because instead of paying 3 items, they are now paying only 2. They're sacrificing 2 items. It's cheaper for them. So when countries specialize according to their comparative advantage, the deals are mutually beneficial. Trade is mutually beneficial. And we have covered this idea in our very, very first seminar when we've studied 10 principles of economics. And I told you that trade creates wealth. This is one of the examples of how exactly trade can be mutually beneficial. That is why comparative advantage is the source of gains from trade. Source of gains from trade. Trade is mutually beneficial. With this information, we now can proceed to answering first 5 questions. What countries don't trade? That's fine. They can just produce both goods, or they can choose one or another or a combination. If they prefer not to, that's okay. However, their welfare will be lower. Because, for example, for US, it will be more profitable not to produce rice, but to buy it instead. It will be cheaper. If they don't trade, that's fine. They will be able to have both goods, but it will be just cheaper to buy elsewhere. We can produce bananas and coffee and possibly oil in our country, but it's just not worthwhile. It's cheaper to buy elsewhere if we can. right? However, another country will also benefit by selling their goods to them, because Colombia probably won't be able to consume all of the coffee they produce. They need other goods, and they cannot produce other goods. For example, I don't know, computers or some other electronic equipment or cars or machinery or anything like high tech. They probably don't have skills, technologies, production capacities to do this, and they would prefer to exchange their coffee, which they're good at producing, into something else. It's just mutually beneficial. They don't have to trade, but it's just more beneficial for them. Any other questions based on this? No? Okay, so let's have a look. The gains from trade are primarily due to the fact that total world output increases when each country specializes. This is what we've covered in the very first seminar, 10 Principles of Economics. Trade increases wealth. Mutually beneficial trade increases wealth. One of the sources of these gains is specialization. This is because when countries specialize, they can produce more output cheaper, quicker, with lower cost. As a result, the combined output will increase. Again, to illustrate this concept, let's look at our table. And let's imagine that countries rely on themselves only, right? So these are their production possibilities, and these countries don't trade. Let's have a look. If countries don't trade, let's imagine that both countries produce a half of their possible production, because they need to divide the resources between producing two crops. So half of the resources will go to the production of wheat, half to the rice. And as a result, they will produce half of each possible output. How much will be then produced? America will produce 15 units of wheat, half of what they can. They will also produce 5 units of rice. Japan will make 7.5 items or units of wheat and 15 units of rice. What is the combined total output? Total world output. 15 plus 7.5, 22.5. Rice, 20 units. This is the total amount which will be produced if countries don't trade. If countries specialize with trade, let's see how it will affect the combined output. Again, the same table, US, Japan, total output, wheat, rice. US will produce wheat. It will produce all of the wheat, and it doesn't produce any rice, while Japan produces only rice and no wheat. What is the total output? 30 and 30. And now compare. How do this compare? Apparently, this is much more beneficial. The combined total output will be higher if you specialize. So this is an illustration how opportunity costs and comparative advantage based on lowest opportunity costs will allow both countries to benefit. So both countries, the global production will increase dramatically from about this amount to this amount if countries specialize. They can make more. They're more productive in specializing in producing certain good. Okay, got the idea? Yeah, that's just a quick numerical example which should illustrate this, and hopefully you will be able to understand this concept better. So comparative advantage is the source of gains from trade. Next, second question. Source of gains from trade is comparative advantage. This is what we've just explained. It's not self-sufficiency. When you are self-sufficient, you probably won't be able to enjoy this high standards of living, because opportunity costs in production of some goods will be higher compared to if you traded. What is autarky? You might be wondering, what is this? Autarky is a situation when you are a self-sufficient economy, when you are trying to rely on your own production only, when you don't trade and you try to produce everything you need. Right? Country like North Korea, they try to rely on their own ability to produce various goods. And apparently, you are all aware how poor the standards of living in this country are. Next, question 3. Mutually beneficial trade cannot occur when the opportunity costs of producing each good are equal for both trading partners. If they're equal, there are no gains from trade. You are exchanging like for like. You are exchanging the same thing. There are no benefits from this trade. Right? So you are producing with the same cost. You don't gain anything from this. It cannot occur. However, this is a very rare situation. You just select another product to specialize and to produce, to exploit these gains from trade. To maximize worldwide gains from trade, the country which should produce a good is the country that has the lowest opportunity cost of producing this good. This is what it should select for exporting. Next, comparative advantage leads to the most efficient allocation of resources and the greatest combined output, right? So, for example, when both countries specialize according to what we've planned for them, we will have the whole world will produce 30 units of wheat and 30 units of rice. And even if we split this equally, it will still be higher compared to if each country tried to produce it individually. Right? They will be able to have more. Okay, any questions based on trade? No? Question 6. When the world price of an internationally traded product is greater than country's domestic equilibrium price, the country's exports of the product will increase. Why is that? Because it's beneficial to sell this product. It's more expensive abroad compared to what you have domestically, and companies will use these arbitrage opportunities. If you can buy something cheaper at home and sell it abroad and get the profit, why not? You will do this. Question 7, trade restrictions in real world. Because trade creates wealth, any trade restrictions reduce wealth. And this is what we've covered in the very first seminar on 10 principles of economics. Trade restrictions will reduce options available for domestic consumers, are likely to increase prices, reduce quality, and so on. So domestic consumers will suffer. If you recall, we've discussed an example where the British economy tried to protect, let's say, Jaguar Land Rover, domestic manufacturer, and to do so we limit the import of other cars like Mercedes, BMWs, Volkswagens, and so on. For example, we impose an import tariff and charge, let's say, 100% on top of the original price, which will effectively double the price for domestic consumers. We've protected domestic manufacturer, however, at the expense of domestic consumers who now will need to pay more. Right? But it benefits domestic producers because they're protected. Consumers will be forced to buy their products. They have less competition, and as a result, they can reduce quality, they can increase prices, and so on. So trade restrictions and total welfare will decline. They will hurt domestic consumers. Tariff. Tariff can be imposed on both exports or imports. It's just an additional tax. You can impose on both sides, both exports and imports. Import quota is the limit on the amount of goods which you can import. So it's a limit on quantity of products which you're allowed to bring in a country. Again, we've covered an example of this in the very first seminar. When we limit the import of Mercedes cars to the UK, let's say 100 cars per year, and that's all we're allowed to import. We cannot have more than this because we don't want too many imported cars to be sold. We want to protect the domestic manufacturer. It's a legal limit on the quantity which can be officially legally imported. Next, we finished with the trade. So the first part covered the international trade. Other exercises will now focus on balance of payments, the next part of the lecture. Balance of payments is the record of countries' transactions with the rest of the world. Goods, services, assets, everything. Financial assets, physical assets. It's a balance of payments. Current account, capital account are parts of the balance of payments. Balance of trade is a part of current account. So this will all represent records of various types of trade. However, the complete record is our balance of payments. The rest will not include all transactions. The difference between countries' merchandise exports and imports is what we call net exports. In macroeconomics part, it's a part of our aggregate demand. And within this, out of these options, it's a balance of trade. It's a part of current account, but it's not full current account. Current account also includes other entries, also includes other transactions. The list of what exactly is included was covered in the lecture. Also includes other transactions apart from trade balance. It's a part of it, but not full of it. And the difference between exports and imports is the balance of trade balance. 12, question 12. The balance of payments is divided into two major accounts, which is current account and capital account. These are two major accounts. Apart from this, we have official reserves account, and we also have statistical discrepancy, which are two other parts of the balance of payments. Which of the following statements is correct? The correct answer would be B here. The overall sum of entries in the balance of payments must be zero, not positive, not deficit, not surplus. It must be zero. Balance of payments must balance. So sums of all accounts must be zero, which implies that if we have a surplus in one account, it will be compensated by a deficit, a negative entry in another account, and the other way around. The difference between the balance on current account and the balance on capital account is balance of reserves account, C. Which means that generally, if we run a combined deficit on both current and capital account, we will have to draw on our reserves. It has to be compensated with our reserves. The balance on reserves account need cover any deficits or surpluses on two other major accounts, current account and capital account. Right. The price of a country own currency in terms of another currency is the exchange rate. Price of a currency is the exchange rate. It's price of a currency in terms of others. So how much is £1 is worth in terms of dollars? How many dollars can we exchange for £1? Or how many euros can we exchange for £1? It's always expressed, price of our currency is always expressed in terms of other currencies, right? And this is what we call exchange rate. How many units of other currencies, foreign currencies, we can exchange for 1 unit of our own. This is an exchange rate. We call our currency a domestic currency, and obviously all others are foreign currencies. Next, all currencies other than domestic currency are referred as foreign exchange. This is what I've just called foreign currency. Not hard currencies, not near money. Near money, we sometimes use this term in macroeconomics, but it's beyond your syllabus. These are other forms of money apart from, for example, from cash and current account balances. There are some other liquid forms of financial assets which you can use. This is what we call near money, but we don't cover this in this module. And this has nothing to do with foreign currencies. Right, next. Exchange rates which are determined by unregulated forces of supply and demand are floating exchange rates. There are different types of exchange rate regimes, fixed, floating, and some intermediate or combined regimes. When an exchange rate is allowed to be determined by market forces, when it floats freely, it's a floating exchange rate regime. When it is set by the central bank at a certain predetermined level, it's a fixed exchange rate regimes. And some combinations, there are some combinations, these are intermediate regimes. There are a few examples, for example, exchange rate bonds or dirty floating and so on. Right, the fall in the value of one currency is called a depreciation of the currency. Depreciation, currency depreciation. It's a situation when the currency falls against other currencies. And a rise in the value of currency is called an appreciation. Depreciation and appreciation. Situation when, for example, pound becomes weaker. We can get less dollars, less euros, less yens for £1. It's what we call a depreciation. Pound depreciated, lost its value, loses its value. And the other way around. Appreciation is when we can get more for £1. There are different terms which we can use. Depreciation versus devaluation. Devaluation is a similar thing, devaluation. It's a situation when pounds becomes weaker. However, the difference between depreciation and devaluation is how it happens, due to what factors. When it falls on its own due to market forces, this is what we call depreciation, due to market forces. For example, because there is less demand for British pounds. Capital leaves the UK, foreigners want to withdraw their assets, they want to sell British assets, they want to relocate their capital to other countries, and to do so, in order to get rid of pounds, they sell their pounds and withdraw, for example, dollars. They want to move their capital to the US. Right? So they will sell pounds and buy dollars. This will reduce the demand for pounds and pound will lose its value. This is what we call depreciation. Devaluation is a situation when pound loses its value due to deliberate policy by the central bank. Due to a central bank's policy. Central banks frequently try to affect the exchange rates of domestic currencies by intervening in foreign exchange markets, by buying and selling their reserves, buying and selling other currencies, and so on. And these interventions can lead to changes in exchange rates, right? And this is what we call devaluation or revaluation of a currency, when the bank does these changes deliberately. So devaluation is when a pound loses its value due to central bank's policy, and revaluation when it gains in value due to central bank's policy, due to a central bank's intervention. So these are similar, but it depends on how it happens, due to what factors. And the final question, under a system of floating exchange rates, there is a general tendency for the currencies of relatively high inflation countries to depreciate. That is why this is one of the costs of inflation. Inflation implies that money loses its value. It loses its value in terms of its purchasing power domestically. We are able to buy less goods for our income. For example, you have 100 pounds. You used to get 100 pounds every single month. That's your, I don't know, student maintenance loan, or this is your pension, or this is some transfer from the government. It's fixed at 100 pounds. If prices in the country go up, if inflation is very high in the economy, you will be able to buy less and less products for this 100 pounds. Money loses its value. But it also implies that money loses its value against other currencies as well, because if you want to exchange your pounds for other currencies, you will be able to buy less abroad as well, not just domestically. It will lose its value not in domestic market only, but in international markets. If you travel abroad, you will be able to buy less with your 100 pounds. You will be able to buy less foreign currencies. It loses its value against other currencies. In other words, high inflation countries tend to have depreciating exchange rates as well. Tendency for the exchange rate to decline. The currency loses its value. So these are all questions for this particular topic. By the way, these are the answers to the main concepts. You can see the answers on the screen. Basically, we've covered everything previously. Exports is what we sell abroad. Imports is what we buy from foreigners, right? Net exports is the difference between exports and imports. Trade surplus is a situation when our exports exceed our imports, when we sell more than we buy. Trade deficit is a situation when exports is less than imports. In other words, we import more than we export. We run a trade deficit. And net capital outflow is the difference between how many foreign assets we buy and how many our assets foreigners buy. So generally, it's the purchase of foreign assets by domestic residents. So capital outflow, how much capital have our residents have taken abroad? What capital has left the country? Minus capital inflow, how much money foreigners brought to the UK and purchased here? What assets they've purchased here? The difference between capital outflow, not output, sorry, outflow and inflow. Outflow minus inflow. Okay, so this is it with this specific topic. Do you have any question in preparation for your exam? No? Okay, let's do economic policy. Again, I will give you maybe 10-15 minutes. If you could focus on all exercises for economic policy. Let me just open them. You can take a quick break and then start this. Economic policy. There are just, I think, 8 to 10 exercises, only just one page, so it's not a lot. Let's do this final page, and then I will explain the solutions in a similar way.